The loan officer training with the mortgage calculator. Today, we're going to be talking about how to quote and structure portfolio loans, aka blanket loans, as we sometimes call them. We'll get started here in just a moment. Just let us go live on all the different platforms. We appreciate all those that were tuning in nice and early. Keep dropping comments there in the chat as you tune in, and also you can feel free to drop questions there in the chat as we go through the presentation here. Hope everybody's having a good evening and ready to get into some portfolio loans. So looks like we're live on all the different platforms, so we can go ahead and get started. We'll take the chat off the screen, but keep dropping comments there in the chat. Drop any questions you have, and we'll be sure to answer them. So welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a correspondent lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is our loan officer training, where we do a training for loan officers on a different loan topic. Today, we're going to be talking about how to quote and structure portfolio loans. Now, the last couple trainings we did were how to quote and structure fix and flips, how to quote and structure ground up construction, and now this is another great one because these are all essentially manual programs that we have to put together, right? There's no automated pricing engines for these types of things. So it's been a great couple of trainings here to really get a grasp on how we do these type of loans. So with that being said, I will go ahead and turn it over to Jose, our sales manager with 28 years of experience, to talk about the portfolio loans, blanket loans. So obviously, I'm sure first up on your presentation is just what is a portfolio loan or a blanket loan.
All right. Good evening, everybody, and thank you for joining us. Blanket loans, another of my favorite loan products because, excuse me, this is one of the products that definitely allows you to provide solutions. One other tidbit there that I want to relay is that if you're dealing with a blanket loan investor and you're offering them a competitive blanket loan product, you are going to have a very captive audience. What do I mean by that? Well, simply put it this way. Do you want to be competing for the borrower that everybody is competing for and they're basically racing all the way to the bottom? Or do you want to deal with the borrower who has few options, and once they find you, the tried and true loan consultant that not only has one of the products that very few lenders out there have, but also knows how to originate that product, how to properly consult the borrower with that product. Hence, they are definitely going to be hanging on every word that you are saying, right? Because they were looking for you and now they found you. And if you don't fumble the ball, you're going to get a nice big loan out of it. So tonight's training is on how to quote and structure the loans. However, the quoting part is more of teaching you the structure so that, and the ins and outs that you got to look for, so that then you know how to properly quote it. Because if you don't understand the product, how are you going to be able to quote it? Because as Kyle was stating, this is not a product that's out there on the automated search engines for pricing nor for underwriting, right? This is a very manual product. Now, that doesn't mean that there aren't pricers out there where you can go set up your loan in certain portals and have a price estimate, like one of the ones that I'm going to share with you today. But what it does mean is that you're going to have to roll up your sleeves and do a little bit of work up front, and the end result will be very satisfying. So let's get into it here and get into how to quote and structure your blanket, also known as portfolio loans, right? Everybody refers to these as portfolio loans. So I guess that's the first thing that I would want to tell you is that everyone refers to these as portfolio loans, but they're actually a blanket loan. The reason portfolio loan may be a little bit misleading because a portfolio loan is also referred to as a loan that a lender has, like a private loan that they do. They portfolio that loan, they keep it, so they have portfolio loan guidelines. So that's not what we're referring to when we're talking about a blanket loan. uh, it's just referred to as a portfolio loan because typically investors use it to finance a portfolio of properties, right? A group of properties, either as a purchase or as a refinance for a rate and term or cash out. So let's get into it. So, what exactly is a blanket loan? Well, like I mentioned, also known as a portfolio loan, is a loan encumbering multiple individual properties, each with their own folio number. Folio number, also a property identification number, whatever they may call it in your municipality. In my municipality where I am, they refer to them as property folios, right? FOLIO, folio. It is not a loan for multi-family properties that have multiple units tied to the same folio number. Every now and then, we run into that misconception, right? Where somebody thinks that a portfolio loan can be used for a property with 10 units when we're actually talking about financing 10 individual units, right? So we could use 10 units and it could mean the same thing, right? I could be talking about 10 units, talking about 10 individual units, or talking about 10 units as in a 10 unit property. So it's very important that we discern the differences here, right? So we're not talking about a multifamily with 10 units, we're talking because that's only one folio number, right? One property identification number. We're talking about 10 individually titled properties. Blanket loans are only for investment properties. That's pretty obvious, but got to put it out there. Blanket loans only have one monthly payment, right? And you'll see why that may or may not be important as we get into the rest of the discussion here. So, this is probably one of the most important parts here to talk about. What are the benefits of a blanket loan, right? This is when you're talking to your investor. Remember, the investor that's coming to you requesting additional information on a blanket loan is probably a sophisticated investor. This is not their first rodeo. You can't be. I mean, if they're refinancing, at least they already have the properties they're refinancing. And if they're purchasing, there's a good probability that if they're looking to purchase a portfolio of properties in one shot, they probably already have investment properties and they just want to expand. And they're looking to expand with less effort, right? You find the 10 properties in one shot, you don't have to find 10 individual properties. So let's touch base on benefits here. Now, the main benefit, this is the one I really want to accentuate. This is the one that's probably going to help you put more deals together, right? When this is the structure part, the structure part is all important because once you got the structure down pat, the quoting part is a piece of cake, right? But this is the key. This is how, and I'll explain this with an anecdote, right? One of my favorite anecdotes. But the main benefit is facilitating the financing of low valued properties that usually cannot be individually financed, basically due to the low loan amount. So, hence, in the bullet point there, 10 $75,000 properties can easily be financed as a $562,500 blanket loan, which would be 75% LTV, which is an option that we have for a blanket loan. We have multiple blanket loan options. We have an 80% option, we have a 75% option, and we have a 70% option. I'm mainly going to be referring to obviously the 80% option here, which is the one with the highest LTV and with the lowest rate, also, by the way. But do want everybody to know that we do have options that at 75% LTV is the one that allows you to finance like a couple of $70,000 properties because they'll go down to 75% of that. However, getting back to the point here, 10 $75,000 properties can easily be financed as a $562,500 blanket loan, but one $75,000 property with a $60,000 loan will be very difficult to finance. I mean, to finance that, you're probably going to have to go hard money. That's going to be a short term loan, right? That's just maybe to buy it in hopes that the equity, goes up, and then you can refinance it once it has a little bit more value. We do have a minimum loan amount of 65,000 on our DSCR loans at an 80% LTV. So you can do the math there, but still a little short there. Now, why is this point probably the most important point for you to understand? It's the easiest one to remember and is the one that has the most impact when you're dealing with investors. And I'm gonna explain, right. Okay. I in this anecdote, right, I had a borrower reached out to me, and he wanted to know what is the lowest loan amount that we lend on. How low can we go? Right? That's not exactly something that we all like to talk about. We love when they come and tell us how high can you go, right? But and when they ask me how low can they go, I don't just say, hey, 65,000 and that's it, and answer the question and okay, thank you, have a nice day, or maybe start talking about that $65,000 loan. I ask them, why are you looking for a low loan amount? What are you trying? What's the objective that you're trying to accomplish? Is what I specifically asked this borrower. I said, are you just looking to buy one property, of low valued property of 75, 80, $90,000 because your budget is low, you don't have a lot of money saved, or are you looking to maybe buy some more properties? And then I went in and I asked him, what is the budget that you have available? What's the funds? So he says, well, I'm looking to buy properties, low valued properties, because they have usually a high debt service coverage ratio, which is very true. I mean, um, he was looking at 90 to $100,000 properties. I found this out later, but this is what was on his mind, and this is what I sort of knew. Why I asked him. He was looking for. He was looking at some 85, 90, $95,000 properties that were renting for like 13, 14, $1,500 a month, and I'm talking about duplexes, so 12 to $1,500 a month per side. These were all duplexes that he was looking at, right, in Milwaukee. Right. I didn't know that, but I obviously hit the nail on the head when I said, are you looking to just buy one property, or are you looking to buy multiple properties? Could you talk to me a little bit more about your budget and what is your objective? And then that's when he told me, well, yeah, that's a good question, Jose. I have about 350 to $400,000 cash available, and I'm looking to see what's the way that I can maximize my rate of return on my equity investment. And I said, well, I'll tell you what you can do is with that amount of money, I could probably pre-approve you for a blanket loan up to like $1 million, 1 million to $1.2 million, depending on the rent schedule on these properties. So what you need to do is discuss with your realtor about finding you multiple properties right? And they all have to be from the same owner. I'm going to cover this point now, but this is why you need to know the structure points so you can consult your borrowers and get the deals, right? Um, so he's like, "Oh, really?" And he was super interested. I mean, hook, line, and sinker, right? He loved it. He loved the idea. We talked a little bit more. We talked about pro, projected rents, like we were talking 1,300, 1,500. We started talking about debt service coverage ratios of like 1.5 to 2.0. I did some calculations for him on what he could expect to pay. And if he had X number of properties at the rental amounts he was telling me, we were talking, it was like 1.8 to 2.0 DSCR. He got really motivated. Went apparently then, okay, he thanked me profusely. We ended the call. He said, "Okay, I'll get back with you." 5, 6 days later, he had two contracts already from the same seller. They just did it in two contracts because they wrote them on two separate days. But I think it ended up being like 9 properties, 8 or 9 properties. I think total loan amount ended up being about 500,000, $600,000, more or less around there. It was a 75. No, I think this one was a 75% LTV deal. DSCR, debt service coverage ratio, right? Most of the same guidelines as you're used to on your DSCR loans. Just the DSCR requirement is a little bit higher on these. Um, Anywhere from 1.1 to 1.2, depending on the outlet that you're using. And he closed he closed on all those purchases, right? One blanket loan, over 600 grand. And it came from a call asking me, "What's your lowest loan amount?" And it came from me making the connection in my mind that what this borrower, and in other words, don't assume anything, right? Don't assume because they're calling about a low value property that they don't have any money. You have to vet the borrower, ask all the questions that you need to ask so that you can properly consult them. And the key word here is to consult. We're not selling anybody anything. We're listening to what they need. We're inquiring on their objective, um, gathering the data, and then analyzing it and doing a consultation. And normally this happens interactively, right? They give you responses, you ask some more questions, you're jotting down some notes, and you're like a machine, right? And when it's all over and done with, hopefully you'll have a happy customer who you pressed all the right buttons with what they needed. You are what they were looking for. And I'm going to tell you what, they're not going to let you go. They found you. It's like a needle in a haystack for them. They're not going to let you go. So this is why, if you're not going to remember anything from tonight, remember that the main benefit for the blanket loan is facilitating the financing of low valued properties that usually cannot be individually financed, right? What is the next benefit? Well, simplified mortgage paperwork profit, as a borrower does not have to submit the same documents multiple times for multiple loans, right? This borrower did not have to do 9 individual loan applications, right? Obviously, the credit's only going to get pulled once, but we're talking 9 individual applications. Yes, if you do them all with the same loan originator, they're already going to have your bank statements and your ID, right? But everything else is individually ordered and everything. So it could be a little bit cumbersome with logistics. There is some cost savings due to the consolidated paperwork and to the value of your time. That's really where you're going to see the benefit here as an investor. The investor found the nine. This person found these properties. All they had to do was find one because that investor had all the other properties. So you don't have to find 9 properties. You may find those 9 properties in one shot, glance at the numbers and say, "I'm all in. Let's do it." Because you know how hard it is to find properties in this market of very tight inventory. However, I will note, very important to note, that there are additional expenses when dealing with a blanket loan. And these have to do with the fact that underwriting and everybody in the underwriting chain and closing chain is going to have to review multiple properties, multiple property records, multiple property appraisals, multiple property title, multiple properties, everything. It's like nine, if it's nine properties, it's like nine little loans tied up in one big loan. So hence, they don't do anything for free. So they add expenses such as funding fees and closing fees, not from the title company, but from whatever conduit we're using, whatever investor we're using for the loan. They're going to add these fees based on the number of properties that are in the portfolio. So some say like from 1 to 5 properties, it's X dollar amount, from 5 to 10 properties, X dollar amount, so forth and so on these funding fees and closing fees, which would then sort of negate any of these benefits that you're going to have from consolidating some of the efforts. But again, there is some savings, and the main savings though is time and effort. So I want to be very clear: do not advertise blanket loans as being a cost saving uh, tool. It is cost savings in terms of time, right? It is going to save time because they found the 9 properties in one shot. Now, this is going to allow you to consolidate multiple loans into one loan, thereby freeing up borrowing capacity tied to the number of individual loans a borrower may have. Wow, that's a mouthful. But what do we mean by that? Okay, let's say you're dealing with Fannie Mae, right? And Fannie Mae, I think, may say you can't have more than 10 properties financed, right? And your borrower is, the full doc king, makes $1 million a year, has perfect tax returns, right? So this borrower wants to keep doing what he's doing, right? But now he's reached an impasse. Now he's at 10 loans. So that borrower could get those 10 properties, refinance them into one loan, and now he has one loan, which is not even an agency loan, and he can start all over again with their 10 agency loans if that's what they choose. The same could be true for non-QM, right? Uh, Depending on the number of loans they have with one investor, for example. But that's usually more a problem on agency loans, right? Specifically, we're talking here conventional loans, which are the ones that would allow for investment properties. So that's a very important point. Some of you may not have considered that. Another good benefit here is it may allow the borrower to access additional equity, as pooling the properties under one loan combines the equity, so that lower valued properties with less equity will benefit from higher valued properties with more equity. You know, because consider this like a blended equity. Like when we do our blended rate, right? It's a proportionate amount of each loan. That's what they look at, and then you get a certain LTV percentage or interest rate when we're talking about the interest rate on a blended rate. Well, this is like blended LTV. You could have now that property that's at 85%, but when you put it into the portfolio in a blended LTV, it could result in now the borrower having additional access to capital that they did not have before. And it may allow for greater power to negotiate better terms due to being a large loan amount. We're talking economies of scale, right? So again, this page here, this slide, should I say, very important to know how to deal with these loans. But just as important, know the disadvantages of a blanket loan. I almost had a blanket loan the other day. It was going to be a really nice loan till the borrower was very turned off by the main disadvantage here, bullet point number 1. And the main disadvantage is that it may be difficult to sell individual properties without a partial release clause. In other words, to individually sell off properties. Now, this is referred to as a carve out, right? Remember that phrase? Your investors will love it if you know the nomenclature. When they're talking about carving out a property, they're talking about removing one property from the portfolio. Now, some blanket loans will allow it with some restrictions, like paying down a percentage additional to the payoff of the property being carved out, like rebalancing the portfolio, basically. And additional, like I had one on my particular deal that didn't work out. There were like five conditions that had to be met for the borrower to be able to carve one of the properties out, including pledging additional net worth and paying down an extra 5%. I mean, a number of things that the investor finally said, "Nah, I guess I'm just gonna finance them individually." And they were already with their bank. They were just going to come over to us because they thought that the portfolio loan, especially DSCR, which they all are, at least the ones we do, was a good idea until we started discussing carve outs. And then, because it was 10 properties and he didn't want to do that. But that is the biggest point to consider, and the one that you should state up front in the beginning to your borrowers. Like, note that there may be restrictions on selling off or individually refinancing properties. Blanket loans are limited by state. In other words, different states have different requirements for a blanket loan. So, for example, if you have properties in 3 different states, you're going to need 3 different blanket loans. You can't have 5 properties in Texas, 5 properties in Florida, and 5 properties in Georgia under one 15 property blanket loan, because each state is going to have different requirements for everything, including foreclosure requirements, for example, right? That's one of the biggest ones right there. If the borrower doesn't pay, what are the remedies? Each state has different remedies. And remember, this is one loan with multiple properties, so everything has to be homogeneous. The properties need to be purchased from the same seller. You cannot put together a portfolio of 10 properties with 10 different sellers, or not even with 2 different sellers. The reason being, when you close the loan, it's not 10 closings on 10 properties. It's one loan, one distribution to the seller, right? So you can't have seller A getting 80 grand, seller B getting 40 grand, seller C, and so forth and so on. It's the seller gets the money on the day of closing. So that's why they all have to be purchased from the same seller. And one thing which isn't as obvious but is super important is all the properties serve as collateral for each other. So one faltering property could jeopardize the entire portfolio, right? So now you're going to have to make it up, or whatever could be the issue with that property, because if they have to foreclose, guess what? They're going to foreclose on everything, the entire portfolio. And likewise, also, if you have a scenario of any legal action against that, you're going to have the same scenario there. They could go against the whole portfolio and not just one property. So very important to note the advantages, and even much more important to note the disadvantages. So let's get into a little bit of the actual meat and potatoes here, right? Now, I just ran this scenario before I got onto this training to have the latest and greatest data, right? This is for our 80% loan to value option. Now, I went to the portal, this particular portal, where I was able to price this loan, and I just needed the data, property address, credit score of the borrower. And by the way, you got to set up all the properties. So in this case, this one was only for 3 properties. It was a 3 property portfolio. They were looking to purchase for 500 grand. 80% LTV would be $400,000 loan amount. So I had to input each property's address, each property's taxes, each property's insurance, each property's rental income, value, all that kind of stuff. And then the system calculated the DSCR, as you can see here on the table, right? You got the DSCR over on the right. My minimum DSCR for this program is 1.1. So we're going from 1.14 all the way down, depending on the rate, starting at the par rate. So again, the basic data that you already know, you just need to have the addresses. If you don't have the address for each property, you're not going to be able to quote it. So you do need all of the addresses, income of the, gross income on the property, the rental income, taxes, and insurance. Minimum property value for this 80% option is $100,000. Keep in mind, this is a full recourse loan. What does that mean? That means that the loan is personally guaranteed by the borrower. However, this particular option, since it's a commercial conduit lending on 1 to 4 unit residential properties, this option probably may not. I know it doesn't, but I say may not because they may change. But this option does not report on the borrower's credit report because this is a commercial conduit. The one that we have at a 75% LTV max also is a commercial conduit and does not report on the borrower's personal credit report, but they are personally guaranteed. That means that if it defaults, the entity defaults, the borrower is going to be personally liable, and they will pursue the borrower, not just the entity. Now, this option does go down to as low as a 660 credit score. However, at a 660 credit score, the LTV does drop to 60%. Our 75% LTV option is a no ratio DSCR option. That means that they're not going to calculate the DSCR on it. They go down to a 650 credit score while still maintaining 75% LTV at a 650 credit score. Mind you, the rates are going to be higher because here in this example, we have par. Our par rate is 8.065. And then from there, the borrower can choose to buy it down. For example, if they pay 1 point loan discount, you're looking at 7.7983, 2 points loan discount, 7.5317. You can do the math. So there are buy down opportunities, not a lot of benefit for each quarter point here. You're getting like 0.875 or something like that. So that's just testament that their par rate is amazing. But the buy down, they probably are not too motivated in having you buy down the rate, but they are motivated in you doing the par rate, of course. I did mention going back to the minimum 650 credit score option at a 75% LTV does allow for a minimum property value of approximately $70,000 because they do allow for a minimum loan allocation per unit of $50,000. Pretty cool, huh? They'll actually allow us to put together a portfolio with as little as, let's say, 2 $75,000 properties. They'll put that for us because their minimum loan amount is $75,000. So in doing 2 $75,000 properties, they're going to be looking at a loan amount of at least 100, 105, which is above their minimum. So they would do it. So real important to note that. So this would be your first option, obviously, 80%. But this 80% option is not a no ratio DSCR option. And on a refi on a refi, this option does require leases. They will not refinance on a vacant property unless the vacant property already has a lease in place that just, it could be a lease that just is going to start next month, but the borrower already has the lease deposit and the first month and last month and whatever it says on the lease from the borrower, then they will accept that. But other than that, if it's a vacant property with no lease in place, this option will not do the loan, but our 75% LTV option will do the loan. So, what are some of the potential issues? This is pretty basic because I'm just going to rehash some of the main points here. Is you have multiple sellers. We already addressed the fact that you cannot have more than one seller involved when it's a portfolio purchase. Multiple states. We already covered the point that the properties all have to be in the same state due to the different lending laws for each state. Property seasoning, right? And again, you all know I love to say this. We're not talking about salt and pepper here, right? We're talking about borrower seasoning on title if it's a refi, and we're talking about seller seasoning on title if it's a purchase. And what do I mean by that? Well, keep in mind that if the seller is on title for 12 months or less on a DSCR loan, and these are DSCR loans we're talking about here, debt service coverage ratio, where the gross rental income from the property is used to qualify the borrower. Gross rental income divided by housing expenses, your debt service coverage ratio. DSCR loans are really big on seasoning. So if you have a seller that's been on title less than 12 months, that is considered a flip. So then you have to make sure that you look at the guidelines to see how to treat this loan if it's a flip. Usually it's going to be broken down into 0 to 90 days ownership and X percentage of profit, and 91 to 180 days ownership, X percentage of profit. And then depending on each of those scenarios, if the profit exceeds the amount that they have as the limit on that time frame, they're going to require a second appraisal, usually is how this situation is handled. And if it's a refi, then that's a different situation. There you're talking about being able to obtain the market value for the property instead of the purchase price plus renovations if the borrower may have just recently acquired those properties. Usually if it's less than 12 months, we got to look at it. But if it's bring out your magnifying glass like you see there, less than 6 months, definitely got to look at it to make sure that seasoning is not going to be an issue, because most of our DSCR options have a minimum seasoning on title to be able to use the market value instead of purchase price plus renovations. They have a minimum seasoning requirement of 6 months. That doesn't mean most of our DSCR options are 6 months seasoning on title. Some are 12 months and some are no seasoning required, but you have to look at the guidelines to see for the specific option that you're choosing for portfolio, but most are going to be 6 months seasoning on title. You could have an out of scope property that you're trying to bring into the mix. What do I mean by that? Okay, your properties are all 1 to 4 units, but then you have a couple of mixed use properties and some 5 to 8 unit properties also in there. That's usually not going to fly. I'm not going to say it won't always, you may get an exception, but you're usually going to have an issue on that's going to require some type of escalation. So if you do have that kind of a situation, make sure you escalate it quickly before you go deep down into that rabbit hole and then find out that you can't do the portfolio loan, you can't originate the loan because of that one property. And the borrower had told you, hey, I told you in the beginning how important it was for me. That's the main one that I needed to refi. So, and then you don't want to lose credibility. So make sure you understand that. And the title on one of the properties could be clouded, right? It could have an issue. All it takes is one, then that property wouldn't be able to be included in the portfolio. So if you're doing this as a purchase, that presents an issue. What are you going to do? Are you going to not buy that one property and then maybe later buy it individually if it's possible once the owner takes care of clouding the title? Does the owner want to do that? In which case you may have to go hard money on the deal if he doesn't want to separate that one property because of the title issue. Hard money will put up with some of these issues, but it's a short term loan. So, again, these are just some of the basic issues, but if you look at the guidelines and learn them, you'll know them all. And last but not least, what are the items needed for the loan application? Right. These are all the basic stuff that you're going to need for most of your business purpose type loans, right? I'm talking about investment properties that are closing in an entity, as these portfolio loans require all borrowers to close in an entity. That is not an option, that is a requirement. So you're going to need your driver's license, personal financial statement, the credit report, the purchase contract for the purchases. That's pretty obvious, right? 2 latest bank statements if it's a purchase. If it's a cash out refi, you can usually use the cash out proceeds to meet any reserve requirements. If it's a rate and term refi, there is no cash out, so you will also need bank statements to prove document reserves. If closing in an LLC, take note of the LLC doc. All right. I hope that you guys got. All right. I think I'm back. Sorry about that, folks. I lost connection there for a minute. If closing in LLC, we talked about the LLC docs. If closing in a corporation, we're looking at the corporate docs that you see there. And then at that point, remember, you're going to price this loan out on the investor portals. Um, the 2 options that I talked about today all can be priced out on the investor portal, right? Just need your logins. You need all the data that I mentioned here, the knowledge that I mentioned here, the conversation with the borrower, and then go price out the loan and offer the borrower options. So again, I would hope that all of you are able to put together a portfolio loan the same way that I put together that one portfolio loan. I'm pretty sure that you're never going to look at a borrower again in the same manner when they ask you, how low can you go in a loan? Can you do, the next time they ask you this, a red flag, a light bulb should go off in your head, and then ask them why, and then see if maybe what they really want is to buy a lot of inexpensive properties so they can have a 2.0 DSCR, and the blanket loan, or AKA portfolio loan, is definitely the vehicle that's going to get them there. And remember, we can do it with as little as 20% down with a DSCR of at least 1.1 and good credit. Definitely higher than 660. The scenario that I ran there that you saw was with a 760 credit, but I didn't check at the minimum credit score at an 80%. You can do that when you go on the portal.
All right. Surprisingly, I don't see any questions.
Well, I guess that just means I did an amazing job. Everybody is going to know right away how to talk to the investors and how to sniff out those portfolio loans.
All right, great. Well, thank you everybody for tuning in. Remember, we do this Tuesdays and Wednesday nights at 7 p.m. Eastern, where we go through a different loan topic. So we'll have some new topics next week. Appreciate everybody tuning in. Thank you, Jose. Great presentation. We'll see you all Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.